Hi everybody. In order to prepare for exam number 1, you truly need to be proficient in writing journal entries and adjusting journal entries. So in this video, we'll practice writing both. As I've said before in a prior video, I know it's very tempting to just listen to the problem and view the answer without actually taking the time to do the calculations. But quite frankly, you are absolutely wasting your time if you approach these practice review videos that way. You will get so much more out of these videos if you will pause the video to give yourself time to calculate the answer on a piece of scratch paper and write the journal entry and the adjusting journal entries. Then start the video again to check your answer. If you got it right, you'll feel great. If you didn't get it right, that's okay. This is just practice. Now's the time to make the mistake and figure out what you did wrong. Now's the time to make sure you know this stuff before you get to the exam. So you will see a detailed analysis of the problem and of the journal entry that you can use to help improve your skills. Then go on to the next problem. On March 1st, we paid $1,000 cash for supplies. Please pause the video, write your journal entry, then start the video again to check your work. This is a journal entry required to record this business transaction. It is not an adjusting journal entry. Debit supplies, credit cash, $1,000. Supplies here is an asset account. On March 31st, we counted supplies and determined that $300 in supplies has been used during the period. The expense we need to record is the amount of supplies that have been used. And in this problem, they told you how much has been used, so you know the expense is $300. This is the last time I'm going to say, please pause your video, write your journal entry, then start the video again to check your answer. You already know that you're cheating yourself in this review if you don't follow that procedure for the entire video and the entire practice session. So we need to record an expense for the amount of supplies used, and they told you in this problem that the supplies used was $300. So debit supplies expense, $300, and credit supplies, the asset account, $300. We no longer have $1,000 of supplies, so we have to adjust this asset account down by the $300 of supplies that were used. On March 1st, we prepaid $3,600 for a 1-year insurance policy. Please write that journal entry. Debit and asset account called prepaid insurance for $3,600 and credit cash for $3,600. It's now March 31st. It's time to do our adjusting journal entries. We need to record an expense for the use of 1 month of this insurance policy. So first you're going to have to calculate your monthly insurance expense, then write the adjusting journal entry. So we paid $3,600 for 1 year or 12 months of insurance. $3,600 divided by 12 means our monthly insurance expense is $300 times only 1 month in this problem. So we need to record insurance expense of $300 for the month of March. Debit insurance expense $300 and credit the asset prepaid insurance for $300. We no longer have $3,600 of prepaid insurance. That was for 12 months prepaid. By the end of March, we only have 11 months prepaid. So we have to reduce the asset, $3,600, by 1 month's worth of insurance. On March 1st, we purchased an automobile for $30,000 cash. The automobile has a useful life of 5 years. Record the journal entry required for this business transaction. There are a variety of asset account titles we could have used. We could have used automobiles. I chose to use vehicles. On the exam, you will have a chart of accounts, so you don't have to make up account titles. So if you used automobiles, that's fine for this problem. I chose to debit vehicles and long-lived asset account, not a current asset, for $30,000, and I credited cash $30,000. Record the depreciation associated with this automobile on March 31st. Use straight-line depreciation, figure out your monthly depreciation, and then write your adjusting journal entry for the 1 month ended March 31st. As we've talked before in earlier videos, straight-line depreciation is calculated as cost minus salvage value divided by life. And I told you in a prior video that when the problem is silent with respect to salvage value, you may assume that salvage value is 0. So in this problem, straight-line depreciation is calculated as $30,000 cost minus 0 salvage value divided by 60 months. There are 60 months in a 5-year period. And that equals $500 depreciation expense per month. And how many months do we need to record the expense? Just 1. We purchased the vehicle on March 1st, and we're making this adjusting entry at March 31st, so just 1 month in this problem. So debit depreciation expense, dash vehicles, $500, credit accumulated depreciation, dash vehicles, $500. Remember, accumulated depreciation is a contra asset account. On March 10th, we received $10,000 for services not yet rendered. We cannot count that $10,000 as earned revenue until we perform the services. Therefore, this needs to be recorded as a liability called unearned revenue or unearned service revenue. We received the money on March 10th, so debit cash for $10,000 and credit the liability account unearned service revenue for $10,000. As of March 10th, we owe $10,000 worth of services to our customer. We have a liability or an obligation to perform $10,000 worth of services. As of March 31st, the records show that we actually performed $4,000 of those services by the end of the month. Revenue recognition principle says record the revenue when the services are complete. Revenue recognition is a little more complicated than that, but it boils down to, in this problem, when the services are done, record the revenue. So our journal entry is to debit the liability for $4,000 and credit earned revenue. And it's called perhaps service revenue. That's the account title I chose to use, $4,000. The point being, you debit the liability unearned and you credit the earned revenue. When you debit this liability, you have reduced this $10,000 obligation to our customers by $4,000 because we don't owe them $10,000 after we already satisfied $4,000 worth of that work. So debit the liability, credit the earned revenue. On March 31st, we owed our employees $3,000 for salaries and wages. So our employees worked for us through the end of March, but we have not yet paid them $3,000 for the work they did. We need to pay them, but we might not get them paid until about the 3rd or 4th of April. So we need to accrue the salaries expense and record the liability that we owe our employees $3,000. Again, there are a variety of account titles that will work. I chose to debit salaries expense and credit salaries payable $3,000. If you chose to use salaries and wages expense or wages expense, that's fine for this worksheet. Debit the expense, credit the liability. On March 31st, we performed services for customers totaling $2,000, but the invoices have not yet been sent, and thus this transaction has not yet been recorded. Revenue recognition says, in essence, record the revenue when it has been earned. Those services were performed in the month of March. We earned the revenue in the month of March. That means we get to record the revenue in the month of March. So you need to accrue the service revenue for the month of March. Debit accounts receivable, $2,000. Credit service revenue, $2,000. On March 6th, we took out a note at the bank totaling $100,000 with an annual interest rate of 12%. Well, what happened on March 6th? We went to the bank, we signed the document that says we promised to pay you $100,000 with interest of 12% at a future date, and we took that check that the bank gave us and deposited it into our checking account. So all we're going to do is increase cash and increase a liability account in this journal entry for this business transaction. So the journal entry on March 6th is to debit cash $100,000 and credit notes payable $100,000. Notice that I didn't try to calculate any interest on March 6th. There is no interest on March 6th. We haven't used the money yet. But as of March 31st, no interest or principal payments have been made. We need to accrue the interest expense as of March 31st, 1 month's worth of interest expense. You remember the formula from previous lectures: principal times rate times time. Go ahead and calculate it and write your adjusting journal entry. Well, the journal entry is a debit to interest expense of $833.33 and a credit to interest payable of $833.33. This is calculated as follows. First, we need to calculate the number of days for which we are accruing interest. This is the first month that we've had this debt. So you take the number of days in March, 31 days in March, minus the day on which we borrowed the money, the 6th of March. That means we use the bank's money for 25 days in the month of March. Then we use the formula PRT, principal times rate times time. The principal is $100,000 times 12% interest times 25 days over the number of days in a year. And remember that bankers think there are 360 days in the year. So $100,000 times 12% times 25 over 360 equals $833.33. So that's all for this video. When we come back, we'll do some more practice. of writing journal entries and preparing adjusting journal entries. See you next time.